Welcome back. Today we're going to take another look at Intel. So Intel was the first video I did, and I don't really think I did it justice. So I want to go through it again without being too repetitive from the other videos. So I'm going to use some different metrics, but I think we're going to get a better picture of the overall financials, okay? So let's start real fast just with the share price history. All right, so this is the 6-month chart. And look, for 6 months, it's been pretty much stagnant. If I take what it was exactly 6 months ago to now, minus 0.2%, so stagnant, right? And if you're a shareholder, I mean, you're probably not happy with this. You know, I know there are some people who say, oh, you know, I don't care if a stock goes down, but I'm not one of those people, right? If I buy something, I bought it because I thought it was at a discount. I want it to go up. I mean, I understand why you want something to go down if you're planning to buy more, but if you've already made your play, you want that sucker going up, right? That's really all I want to talk about there. This video, and really all my videos, are focused, y'all know, on the financials of the company, on the financial statements. So that's what we're going to start with. First up, income statement. And first thing on the income statement, total revenue, all right? This you always look at. You always want to make sure it's growing in a company, or at least flat, but preferably growing. If revenue's shrinking, that's really not a good sign. And I mean, we don't have to worry about that here. It's growing. This is every quarterly report going back to March 2006. That would be first quarter 2006. So keep in mind these numbers, whenever we do our calculations, we're going to be multiplying by 4 just because this is quarterly reports. So to get a yearly, we got to multiply by 4. Next up is gross margin. So I love gross margin because, or any margin, right? Because it shows the company's competitive strength. So if you're in a highly competitive industry, you're going to have lower margins because there's so much competition out there that if you try to charge a higher price, somebody's just going to continuously undercut you and you're going to lose market share. Well, the opposite's true if you have a strong competitive advantage. So if you have an advantage over everybody else and you have little competition, you can raise prices and charge your products at a premium. And I mean, that's what Intel looks like they're doing, right? They have about a 60% margin historically, so that's strong. Recently, it's declining a little bit, but that's not a big issue because it's still pretty high on an absolute basis. All right, another percentage is next. This is research and development as a percentage of gross profit. So what this is telling us is how much of the company's gross profit is having to go into R&D. R&D is the company's investment in staying on the cutting edge of technology, right? And since Intel is in a fast evolving field, their R&D expenses are going to be pretty important to keep an eye on. So what you would really not like to see here would be R&D percentage going up significantly, you know, because that would mean that either you're having to spend a lot more to stay on the cutting edge or you're making less gross profit, right? In general though, this is pretty high, right? 35% of your gross profit is going into R&D. That's a big chunk, you know, over a third of your profits are just getting spent trying to continuously innovate. But that's the business, right? Let's look at interest per operating income. So what this is going to show us is how much debt a company is really relying on to make money, right? Because if a company's in a lot of debt, then they're going to have a high interest payment as a percentage of their operating income. And let me remove this one, just these two, just to get the scaling better. All right, so they are recently running, you know, between 0 and 2% interest per operating income. That's awesome. That means that they have very little debt load. There's not really a financial risk there. I love seeing this. This is big gold star, check mark, whatever you want to call it. All right, let's look at our pre-tax income. All right, so just like revenue, you like to see pre-tax income growing. That's great. And I use this to do evaluation on companies. I explain why in my other videos. I'm not going to do it here, but let's do this. Let's take the average of the last 8 quarters, the last 2 years. So if I do that, I come down here. The average of the last 8 quarters is $6.2 billion a quarter. So up here in the calculator, 6.2 times 4, that's $24.8 billion a year in pre-tax income. 24.8. All right, now I want to get a growth rate here, okay? So get a growth rate, you just take the number you just got for pre-tax income and then you go back, you know, 5 or 10 years, however long you want, and then annualize that growth rate. So I'm going to go all the way back to over here about 2012, this area, and you can see they were making a little over $4 billion a quarter. So I'm just going to use 4. So up here in the calculator, 6.2 divided by 4, all right, and then raise that to the 1/10. And I'm going to get an annualized growth rate of 4.4%. I'm going to be conservative and just say straight up 4%, just because I like to always be conservative with growth. I think if you overvalue growth, you're going to overvalue the stock and you're going to buy something that's worth less than you think it is. That's just my opinion though. All right, so next is earnings per share. Let me go down here and get it. Where is it? Right there. All right. So this is growing too. I'm going to do the same thing. Take it this number, the last 2 years, the average of the last 8 quarters. So if I do that, I get $1.28, so $1.28 times 4 to get a yearly number. All right, 512, awesome. All right, let's go to the balance sheet. All right, first up is return on tangible assets. This is my favorite combo metric, I think, out there. I call it a combo metric because you're combining, something from the income statement with something from the balance sheet. But you have return on assets, return on equity, return on invested capital. My favorite is return on tangible assets. And what got me really to start thinking about return on assets is listening to Warren Buffett. So he has a video where the interviewer asks him what is a good business, and his answer is it's all about return on tangible assets. That's what a good business is. He goes on in the video to say you want to buy it for a good price, but as far as what makes a good business, this is the number one metric. And I agree. I think this is the most intuitive, right? Return on tangible assets is how much money are you making, and then how much are your tangible assets worth, meaning your assets that are real, physical, can be sold for something. They're not goodwill or intangible, nothing like that. It's like an efficiency rating almost. I think it's awesome. So this begs the question, what is a good return on tangible assets? All right, so there are three ways to think about this, kind of like how we think about margin, right? There's an absolute basis, there is a relative to the rest of the market or relative to competitors, and then there is a relative to its past history. So relative to past history, return on assets or on tangible assets has actually been going up over the last, 5-6 years? Great sign. So I think on an absolute basis, 15% is pretty good. Anything under that is a little iffy to me. And, once you get into the single digits, I'm not happy. Intel is around 20, let's say. All right, next I want to look at total assets, because in the video, Warren Buffett said a good company earns good return on tangible assets, but a great company earns good returns on those assets even as their asset base is growing. And look at this. Shoot, the assets are growing, but Intel has maintained or even grown their return on assets on incremental capital. And just real quick, a word on return on invested capital. I think that is just as good a measurement as return on assets. Invested capital versus assets is almost the same thing, right? Invested capital is all your interest-bearing debt plus your equity, whereas assets is all your liabilities plus your equity. So your total assets are going to be a little bit higher than your invested capital, but in general, they're really close together. So I'm okay with either one of those. Return on equity is what I don't like. I think that you can get fooled by somebody who's super leveraged and doesn't have a lot of equity showing a high return on equity. So I've kind of recently started staying away from return on equity. I think it can be misleading. But yeah, look at this. Growing assets, they're over $160 billion in assets, and then 15 years ago they were at 40. So that's quadrupled in 15 years, and the return on those assets have maintained about the same level. Bravo. All right, now let's look at a ratio to check the leverage of the company. Again, the debt to equity ratio. So I like this ratio because it tells me how leveraged a company is. And to be honest, I just like to see it below 1. Below 2 is okay. Really, below 4 is okay, but the lower the better, right? For me, I don't like debt, right? I don't like it in my personal life, and I don't like it in the stocks I own, but that's me. So I am biased towards companies with low debt. This gets a check mark too, though, because all these numbers, even though it's rising, is under 1. I think once you start getting down here, that's pretty conservative. You might be losing out on some easy low interest debt by being so low, but I'm never going to get upset if a company's got low debt to equity ratio. All right, let's go to total liabilities. And the reason I'm going to write this number down is because I want to use a metric, another combo metric from the cash flow statement once we get there. So all I'm going to do is write down the most recent liability number. So let's see, it's 77.8 billion. So I'm just going to say 78 billion over here in the outline. All right, now we're going to look at number of shares, and we like to see number of shares decreasing, right? Because that means that we have an increased stake in the company, but that's not the real reason I like to see it decreasing. Okay, the real reason I like to see ordinary number of shares decreasing is because it means the company's buying it back. And if the company's buying back shares, that usually means that management thinks the stock is undervalued. If management is rational, which I understand is not always the case, they will buy back shares whenever A, they have money, and then B, they also think that the stock is at a discount, and more of a discount than they can get by reinvesting that money into their business. So for example, like if you're getting 20% return on assets and 20% return on incremental assets, meaning every asset you own, you're still getting 20% on that, why would you buy your own stock if you thought it was 10% discounted whenever you could reinvest in your business and get 20% on that money, at least 20% on the money, right? So that's the real reason why I like seeing this going down. So this gets a check mark too. All right, lastly, tangible equity per share. We're just going to look at this fast. This is like a liquidation value for the company. This is all the assets minus the intangible assets minus the liabilities divided by the number of shares. This is like a net worth. We like to see this rising. I kind of view this like I view personal finances. You should really judge yourself more on your net worth than your income. If you're making a lot of money but it's just being spent left and right and your net worth is staying the same, you know, what's going on? You're not really winning, right? But even if you're making a modest salary, if you're living within your means and investing well, you're going to grow your net worth and equity, and that's winning. All right. So that's all I'm looking at here. And yeah, it's growing. Check mark. All right, well, let's go to cash flow statement and wrap this up. Oh no, I still got to do valuation, huh? All right, so free cash flow. Free cash flow is a great check to your income, especially your pre-tax income. They should usually be about the same. And if they're not the same, we always like to dive in and say, why aren't they the same? All right, so I'm going to use the same tactic I did for the pre-tax income, where I take the average of the last 8 quarters and then multiply by 4. So the average of the last 8 quarters was 4.7 billion. All right, 4.7 times 4, that's $18.8 billion. All right, so let me write that down. This one's a little bit lower than the pre-tax income, so we're definitely going to want to dig down further and see what's going on. Real quick though, that ratio, I'm going to do that fast. All right, so 78 billion divided by 18.8. So this is all of the liabilities for the company divided by their free cash flow per year, and this tells you how many years it would take for a company, if it wanted to just pay off all of its debt. It's just another good way to get a feel for how leveraged a company is. So they could do it in 4 years. The liability to free cash flow, the debt to equity, the interest per operating income, those are all really like 3 different ways to tell the same story. But remember, the purpose of these videos is not to analyze one company, it's to teach the methods so that you can go analyze whatever company you want. The bonus is that we get a unique valuation for every company. So, all right, let's dive into why this free cash flow is different. So usually if free cash flow is different than pre-tax income, it's going to be a discrepancy between your depreciation and your capex. Let's look at depreciation first. So depreciation is how much value are your assets losing on your income statement every quarter, okay? So this is like a on paper loss. So you can see right here, it's about 3 billion per quarter in depreciation. That's what our assets are losing. All right, in reality, we like to look at capex, right? Because capex is reinvestments back into your assets. And so that can usually be the discrepancy. All right, and you can see, yeah, the capex is over 4 billion on average. Now, the exception here, though, is that capital expenditures can also be investments into new operations, so growth. So if you see higher capex than depreciation, you need to make sure that the high capex is going into new projects or new ventures and that the company is growing. And in Intel's case, they're growing, and we know that recently they're going to take the strategy of higher capital expenditures so that they can get back on track with some of their competitors like AMD and who's the other one? NVIDIA, I think. All right, well, that's all I have for the cash flow statement. Let's go to valuation. Let's get a number. All right, first one, rule of thumb method. This one, I know it's simple, but I stumbled upon an article one time where somebody looked at all the recent Warren Buffett purchases and was like, oh, he actually buys stuff around 10 times pre-tax income. So I started using that as a rule of thumb, and it's been pretty good for me. I found that my best investments come from quick valuation calculation, but a deep dive into potential red flags, gold stars, green checks, whatever you call them, and paying more attention to the qualitative side than the super detailed quantitative side. But that's just me. All right, so rule of thumb method, 24.8 times 10 divided by the number of shares, 4.06. All right, $61 a share. All right, so next is our Ben Graham formula. That's a combination of earnings per share and growth. Quick disclaimer on this one. He did not write this formula as this is what I use. He actually wrote it as a rule of thumb method for all these other complex formulas that were out at the time trying to predict share price. And he's like, hey guys, all these crazy formulas with log and cosine, I don't know if they had that, but they could be reduced to this simple formula. So 512 times 8.5 plus 2 times growth, so 2 times 4, all right, awesome, $84. This one's usually high, I'm gonna be honest, at least in my opinion. So just take this one with a grain of salt if you use it in the future. It's pretty high. All right, and then lastly is gonna be a discounted cash flow model. And to do that, I'm gonna put our free cash flow in billions, so 18.8. And then a perpetual growth rate, I'm gonna do 4%. I think that's pretty reasonable that they're gonna grow at 4%. I mean, they're making, what, 20% return on assets. That's awesome. All right, and then what do you put for discount rate? I put 15%, but let me talk to you about why that's probably on the high side. A lot of people use 7.5%. A lot of people use 10%, 12%. I think 12% is probably the right number here, but I am very conservative. This is just my approach to investments. So my net present value is 197 billion. So 197 billion divided by 4.06, and I get $49 a share. All right, so real quick, let me talk about the discount rate some more. Okay, so how do you know what number to put there? Intuitively, this is the question you should ask yourself. If somebody told me that they would give me exactly $100 1 year from today, how much money would I pay right now to get that $100 a year from now? If you would pay $90 to get $100 a year from now, that would be like, 10%. If you're going to pay $99 to get $100 a year from now, well, your discount rate would only be like 1%, and that would just be silly, right? Who would do that? But that's just a good intuitive way to think about what discount rate is. What do I think about the share price? I think it is definitely undervalued because my metrics are pretty harsh besides this middle one, but they're usually on the low side. So to have it still undervalued with all the positives that I saw in the financial statements, this one is it's kind of unbelievable, to be honest. It's a great company. I saw almost no red flags besides maybe the high capex. That has to translate into growth eventually, or else it's wasted. But I trust them. They've made good returns on incremental capital. I have no issue with them increasing that capital, right? Now, do I own shares? Not currently. So I've been watching this one for a really long time. My issue is I really, really believe in a super concentrated portfolio around businesses that you either know well or understand. And everything I own is very concentrated and in the industry that I actually work in every day, or closely tied to that industry too. It's either that or it's a company that's really simple and even I can understand. My biggest hang up in buying Intel is that I don't really understand the business and the industry as well as I'd like to. I'm trying to learn more about it. I'm not at that comfort level yet, but I think objectively the financials are like an A+ right now, and the value is there too. So I think it would be a great investment if you had a strong understanding of the business and knew what to look for as far as if you saw any signs that you should be selling. Let's say that one of their competitors came out with something that was just going to revolutionize the industry and just leave Intel in the dust. Would you be involved enough to know if that had happened? I'm not there yet. That's just my opinion though, right? Like I said, these videos are to teach the investment principles. They're not to give financial advice on individual stocks. It's just a bonus that we get a valuation on a stock each time, because I think using real companies is the best way to learn. But anyway, if you did enjoy it, if you did learn something, please like and subscribe for more, and I will see you next time.